The beginner's guide in trading any instrument in the financial market, so being it Forex, stocks, synthetics, and all the like. So I'm going to talk you right. So first of all, look at it. Market movement is in three dimensions: contraction, expansion, and delivery. Okay, these are the three major movements. So they call it accumulation, manipulations, or whatever, and distribution. So I call it contraction, expansion, and delivery. Okay, so market have a pattern of movement. So it accumulates, right? So which is contracting. So contraction first take place and eventually a breakout. So we have expansion. So it can get expanded to the up and then deliver to the down. And of course, still return back to the contraction as had market move. All right, per day. Now, so I call it CED, market phases. So trading magic for beginners. Top 10 trading magic for beginners. Number one, top-down analysis. All right, key levels and daily bias. Top-down analysis. All right, key levels and daily bias. So let's go. I'm going to take, first of all, of course, you're going to need a trading view. I'm not going to go detail on how you use trading view or how you create trading view. If you don't have trading view account, you can check my comment section and then click on the link. Make sure you have your Gmail or email available on the link so that you can just connect as fast as possible. So let's quickly go. We can take any instrument. So let's take perhaps, let me just take any coin of my choice. Let me take fat coin. Yeah, so let's take fat coin, any coin at all. So now we have said, first of all, so let's go to daily time frame. There are other things you will need to know, but just for beginners, don't complicate issues for yourself. Okay, fat coins, unfortunately. Let me take a coin that perhaps, let me take LTC, Litecoin, that have more historical data, so we can be fine. Okay, so I have some tools that you're going to use, okay, for your trading. So I've taken Litecoin. So let me just take off these tools for you, right? So that we can be in a very nice. So now let's go. This is daily time frame of the candle. So first you want to do is to go to your the candle and change it to a line chart. And of course, I want to check key levels. All right, that's the first thing, top-down analysis, key levels. So I'm going to take my horizontal line. So connect all this. And then I take the next one to, just where I can get them connected, right? Perhaps I just want to have something. Okay, so let's take it to this point. I could take another one. So perhaps maybe some other kind of pairs of currency, perhaps maybe somewhere here. So let's just leave it at that. Okay, these are key levels. And on key levels, I want to get my daily bias. Okay. So what my daily bias ordinarily today is, so this is a daily candle. So what happened is that candle have some stuff they do when you wake up, probably when you wake up. Now this candlestick pattern, now the candle close and open is very important for you. So previous day candle is this guy here, and now that is to say this candle, every candle had four components: the high, the low, the open, and the close. Okay, so here you have, this is a bearish candle, not because of the color, but where it opens from. How? When you have a bullish candle close, that is it close up, and the bearish candle actually open at the close of the previous bullish candle. And what it did was that it first went up to create a high and then start going down and closes here, which make it bearish for that previous day. Okay. So if that's the case, it bearish for this previous day. Now, that is, it opens and went up and then, of course, came down and went down and eventually closed. And so that's why I would say we have contraction and expansion and delivery. And of course, return back to contraction again. So let's quickly look at it. Remember, this is a beginner course. What to do, some process for, let's go here this way, just a moment. Okay. Remember, this is just a beginner course. So if you are in our group, we just need this one to be done for some of us to understand. Every time we give you information, signals to trade, some things will come to your mind and to be able to follow up, taking up your trade as it were. Just a moment. I need to create a login to a place here. Come on, come on, come on. Okay. So it's coming up. All right. Okay. So let's go. So like as I was saying, I said beginners course now. So that's exactly what I'm trying to share with you. So we said market move by contrasting and next. So the magic top-down analysis, key levels and daily bias. So that's where we are trying to get the bias for the day. So now, and I come for the day and I saw the candle, previous day candle close and it was bearish, which was this. And today open and then of course first went up and then was going down. Now today has not closed, which means today actually where you come was bearish. So you will find out that candle. So you want to go down to 4 hours, probably to give you some other substructure, right? Now the market is actually very, very dull. Yeah. So on 4 hours, sometime I could just plot a trend line, all right, to find possible chances of whatever. So, but this is very clumsy somehow. So I want to go to 1 hour, especially if you are a day trader. Now, going to 1 hour had confirmed to me where was the market coming from, right? Market was coming up from the key level, which was up here, and then eventually created a low here and a high here. Okay. So another low, another high. So a low is created. So ordinarily, when the market opened, it went up to grab liquidity, which we'll always say. Now, so this is 1 hour time frame, top-down analysis. There's something you must understand when you are trading. Top-down analysis is that, okay, I've discovered that this market is bearish. So I'm looking for a way to short. Do I just go ahead and short? So there's something I want to make you to understand. Number one, we have talked about top-down analysis, okay? Top-down analysis, key levels, and daily bias, which you structure mapping. Now, price action. Price action has to do with candlestick and, of course, combination of candlestick. How do I mean? Candlesticks give you some interpretation and combination of candlesticks equally give you some interpretation. How do you mean by that? Okay, now each of these candlesticks represent an action and they open and appear in different dimensions. Now, you have some candles, they will say it's called doji, gravestone doji, hammer, pin bar, and all of that. Now, so one of the things you will need to understand in this dimension is that what actually give those definition to those candle pattern. What actually give definition to those candle pattern? What give definition to them is that this candle, like this market was an uptrend, right? You see the way I just marked this now. Now, if I channel it, you're going to see it properly. I'm not asking you to do that, all right? But just to show you a dimension that you know that this market was actually an uptrend. Now, as an uptrend market, so you probably are looking for where to either long or short, depending on understanding you have about the market. Look at it. Good. So now this is this here, right? Don't get it complicated, okay? So what has happened here is that we said price action. Price action simply means the origin from candlestick, that is formation of the market movement, price. So candle is the first thing. So I haven't gotten this candle, is that this candle came down. So the market was actually crashing down, right? And then eventually came down to this point and create what we call a low. And fortunately enough, ran back. The interpretation of this candle is that market was selling down, but there were more buyers who quickly come in and then wipe off, and the market went up here. And then eventually we have an engulfing candle, a candle that opened that become longer than the previous one. It engulfed the old one, especially when the old one is bearish and the new one become a bullish one. So which means this is a sign of the market actually going back up. So now the next thing you want to look at in the market is that they call something market structure. Okay, they call something market structure. If you understand price action, which has to do with combination of just a moment, which has to do with the combination. Okay, good and fine. This one is reacting. Okay, so we call something price action. So combination of where's this guy? Okay, oils, good, okay. So price action is a combination of candle formation and chart. So multiples of candles form what we call chart. And so we have different chart patterns. Don't cram them, it's not necessary. But the point is that if candle has formed this way, then it combines and begin to form a kind of dimension, flag, blue flag, boy flag, all of those things. But the first that is very important for you is to understand the anatomy of candle and when they form to create a chart. Fine. So, but if candles have been formed, you can know that, okay, this one, market was selling down massively. Fortunately, buyers step in and take over the market, and that's where you see the market start going up. Now, the question you ask yourself is that, should I come into the market immediately I see that the candle is now engulfing? No. But if you look at this market, so we have what is called an uptrend here. The question you ask me, market structure is the formation of market in layers of its movement. Market structure is the formation of market in layer of its movement. And that's where you have the content, the major aspect of this market structure is called high and low. Okay? High and low. So we have high and low. Now, high and low now have in two categories. Okay, we have high and low. So high and low now have in two categories. When it's an uptrend, we are going to have a higher high and a higher low. When we're going to go to downtrend, we're going to have a lower high and a lower low. Get it right. So here, since this is high and low is the market structure. That is, market start from somewhere down, which is a low, and go up somewhere, which is high. So there's going to be a swing low and a swing high. So understand this? So that is, the market come down, is swing down, and then start moving up, which is now swing high. So when we are looking at the market, we look at the market like this from a swing. Let me just take a line here. So we look at the market from where? A swing to another swing. Can you see now? Okay. So this swing is low, while this swing is high. So we have a low and a high. So being an uptrend, what we are going to have is when the uptrend is going to continue, it now forms something like this. Okay. It now forms something like this. Since we have a high now and we have a low. So if the market is going to continue, we're not going to have something like this. Since this is a high and the previous play was a low, it will now form another low. Are you getting it now? Now, another low that is being formed must not get to the previous low. So we now say, okay, since another low is formed, it now creates another high. Again, it creates another low. Okay? Again, it creates another high. Again, it creates another low. And finally, it creates another high. Let's stop here. Now, this is very simple thing. Now, not all the time the structure will form like this. We call this one a kind of textbook pattern. Okay? So, not all the time that the market is going to give you this formation. Now, but what we are saying is this. There was a low and there's a high. The next low created was not down to this point. That's what gives the name higher low. So what we're going to have is this. Look at it. We have LL here, which is the lowest. Okay? And then you have high here. So you have HH here. Now, you have another low here, but it's not as low as the previous one. Do you get it now? So that is to say you have, what do you have here? Somebody answer me. If this one is LL, now this is another low, but it's now higher than this. What do we call this one? Did you say lower high? Okay. If you call it HL, which is higher low, you are correct. So this is low compared to this high, but higher than this low. That is to say, you are now finding a very nice structure that the market is actually going up. So the next you are now going to have is another formation of high. Okay, so we are now going to have another high. So this high is higher than this. This low is lower than this. This low is higher than this. Now, the presence of new low gives strength to the previous low, make it stronger. So again, you now have another low here. So this low will now become another higher low. Okay? So you don't say it times 2 higher low. Okay? So you have another higher low. So this structure is going up. Now, when you now look at the market continue to move up again. We have another higher high, another higher low, another higher high. Now, this is where it's becoming more interesting. It's becoming more interesting because you are now looking at the way the market was moving. So what we say is that this is a market structure. Here is the lowest. Okay? You know you are not trading here. We are going to go to the lower time frame. But here is the lowest, and here is the swing high. Okay, I can even extend it out. So you are going to let something from it, but let's stop it here. Okay? Now, here is a low. So let's stretch it out. Here is another low. Now, here is another high. So here is another low. Then here is another high. And then here is another high. So for now, on 1 hour time frame with this coin, this is the highest in your own measurement now. Here was a low, here was a high, here was a low. Now, when the market came down here and now move up and passes this place is what they call break of structure. That is, it has broken the structure. It didn't stop. It break the structure, it shoot ahead and render this one lower than this next one. Now, the market again have to correct back. So this is a correction, what we call pullback. So you don't expect the market to just be going in one line. And that's why when you are trading a coin and it's just going without any correction, what caused all this correction is that people are taking profit, people are shorting, one decision countering other decision. And all of those things are very, very important for trade to be very effective. Now, so here, didn't get back to this. Then you have the market again move up and crosses this, another break of structure. The market return back and create another low, and then again move and crosses this, another break of structure. But now this is getting more interesting. Why is it getting more interesting? Very simple. Though you may not wait to this point, you go to a lower time frame, but in the 1 hour time frame, now this is getting more interesting. The market is already bearish. How? This was the lowest, right? This was the lowest. This was the swing low that brought this highest. And this was the previous high that was broken. Now, so when the market moved this way, it went up and came down. All this movement is doing is not an issue. The moment the market now came down and create another low here, are you getting it now? It creates another low here. Let's take it this way. So now there's a problem here. And the problem is simple. What's the simplicity of this problem? This guy, the way it was going, it has been interrupted. How was he interrupted? This broke this guy inside here. That's what they call MSS, market structure shift. Market is now shifting from uptrend to a downtrend. Are you following? Now, since this is the guy that created the high, all right, this is the guy that created the high, this low, that have interrupted, that disrupted the market. So the market crashed down here. If the market has gotten here and move up again and break this, market continue. But the market came down and broke this. Now you are interested. See much of your interest. Much of your interest is now this place. But there's something you must understand. You know this higher time frame. If you go to lower time frame now, maybe 15 minutes, if you are a day trader and all of that. There's something very, very important you must pay attention to here. Sometime when the market break the structure that's shift the market, it can rally up again, right? When it take this low, it can rally up again, all right, to form, some people call it KOML, all right? And this is the high that brought about this low, and this is the low that brought about this high. So the market grabbed this sharply sometime and return. When it returned back here, you are looking for a sell position in some cases. Now, because those cases could be that you go back there, you're going to see what they call order block or fair value gap and all of that. But I'm not going to complicate this issue. You have seen how the market structure actually formed. So if you have seen this, so that is market structure for you. So we now said that, sorry, just a moment. Let's do this. Let's check. Okay, this guy could not make it. Okay, we now say that, okay, this guy is very simple. This guy that had formed this up, down. Now, what you are looking for is that these guys will break and return back to this point and get rejected. Don't let it take this. If you take this, it's no longer valid. Now, but in this case, the market actually returned and got rejected here. So the moment it's rejected here, most time, sniper entry trader will be looking for a sell position. But you will not look for sell position on this 1 hour, especially if you're a day trader. You are going to go to 5 minutes to look for a sell position. Yeah. To enter the sell, you have to go to like 5 minutes. If you're on 1 hour structure, internal structure of 1 hour is 5 minutes. You're going to go to 5 minutes. But nevertheless, so in your case now, if I mark this point, let's look at it. So let me mark this point. And of course, here that you were looking that the market should come down to. Now, let's go to 5 minutes. Okay, so going to 5 minutes, you saw that the market, of course, created some internal structure. You want to find a rejection from this point of 5 minutes, and which happened, and that will have been your selling entry, all right? Targeting any kind of low, as it were. Now, what I'm doing here is very simple. Price action, okay, top-down analysis, price action, market structure, then trend. Of course, in explaining the higher high, higher low, may help you to identify a trend. What a trend? That's the direction of market pattern. And we have three major trends, however. We have an uptrend. So you saw on that 1 hour time frame when we had a higher high, a higher low, a higher high, a higher low. So that's a trend. So that means this market was actually an uptrend till it got onto this point and creating a downtrend. Okay, so the movement of the market towards a particular direction is referred to as a trend. So you can now have either an uptrend or a downtrend. So when it's perpetually going up, create high, and another low, high, low, that's an uptrend. Now, when you get to a point, it breaks the structure that was formed, it makes a shift in that movement facing the other direction. That means it's now going to be having a downtrend. So instead of an uptrend, become a downtrend. Then at a point, the market become choppy. It will now be ranging in a box, right? Creating, it won't shoot out. It can even go to the same point it was before and reject again in that order, then you are tempted to call that a range band or a sideways market. Okay. And we always say that as a beginner, if you don't understand the market properly, go, abstain from trading any sideways market. But sometimes when you want to trade it, you want to go to a very good lower time frame to find an entry to such trade. Okay. So that is where we come about trend, demand and supply zone. Now, I have so if you are going to struggle to understand demand and supply zone, it's not a problem. But demand and supply zone is actually a zone at which major buy and selling decision was taking place. But demand and supply zone are more valid on higher time frame, like 1 hour, 4 hours, daily, and all of that. So that will give you a demand and supply zone, right? Now, they are similar to a kind of order block, but the difference is a little bit because not every demand and supply zone make it another block. Because another block, what validates another block, it must have a preceding fair value gap. Okay, so I'm not trying to conjure so many of those concepts just to pick them. I'm not teaching you ICT and all of that, just normal market settings and all of that. So demand and supply is actually a point of interest where people, where, instigating kind of buying or selling activities happen from that region. So it is said to be that market always find it root back down to that point because of the activities of buyers and sellers at that region. So demand and supply zone are very important. So people trade, so you can say it's a major key level 2. People trade from one supply zone to demand zone and all of that. So where you have much selling pressure, it's said to be a supply zone and all of that. So liquidity is a left point of in ICT concept, they mentioned about liquidity to be a place where a Shona trader want to go and grab some volumes that were left by virtue of stop losses. And it is said to be that liquidity are much available as stop losses point, which is the point of support and resistance. That liquidity is much available at the point of support and resistance, either by diagonal support or a horizontal key level, which, for instance, you can see here. All right, you can see here that if I look at this trend line, look at it, that liquidity is seated here, liquidity is seated here, and all of that. You say why? At every swing region, there's a liquidity. That because people will find out that, okay, market have been, bouncing from here, they perhaps will enter a trade and put their stop loss below, and so they can going to be a liquidity hunt, whereby institutional traders now grab those liquidity, and that's what talk about liquidity. I'm not going to detail about those things, but just to show you some dimension, you want to expand your knowledge. Order block, I've said that order block is a place that represent a sudden movement of the market, maybe back. For instance, let me take off all of this. Let's take off this. Okay. Now, if we take off this, right? So let's take off all of this. Now, let's look at order block. Now, when the market is going up, a point at which the last bullish candle got to before a massive sell candle come up is tend to be another block. So if you want to look at, this can be a demand zone, right? Right? But now, which candle is going to represent our demand zone? Supply zone. This engulfing candle, the entire environment here is a supply zone, right? So sometimes could be the wick to the body of the candle, a supply zone. Now, where's our order block? Order block is actually, do we have order block here? The answer is yes. How, Felix? Now, let me show you. This 1 hour time frame. We said what validates an order block is that there should be a fair value gap. Okay? So now, this is the last bullish candle. I think this was bullish, even it was a gravestone doji. It was a bullish candle because it closed bullish. Now, I'm going to take it now from the wick, the high of that candle to the low of that candle. This is the order block. And that's bearish order block. Now, look at what happened. Sometime we want that to be mitigated, not all the time. So here you have, you see, the wick of this candle to the wick of this one is actually what they call fair value gap, FVG. That is an imbalance in the market. Look at it. From this point to this point here is what they refer to as what? FVG, fair value gap. That is an imbalance. That the market move coherently by meeting the previous point to meet the new point. So where you have the gap of the previous one, so there are three candles that will make a valid fair value gap. Three candles will make a valid fair value gap, meaning the candle that started and the second candle that creates the gap and the third candle that refused to get connected. But will it just be that? Now, when you have the wick, you have to have wick in both the first candle and the third candle to be a strong fair value gap. Okay. So, and most time the fair value gap that precede another block, it tend to be more stronger. So the market is expected to perhaps come back to the fair value gap and mitigate it, or come back to entire order flow, which means the whole environment from the other block with fair value gap is called an order flow. And then, so the market is expected to come back there and mitigate. And when it come there, close the gap, then it's set to sell down. Okay. Now, but these are concepts. Okay. Sometimes market may not actually come there as it were, but that means it has not been mitigated. All right. Okay. So why I have to show you this so that we can learn, of course, know how to understand, the market. So we'll talk about liquidity, FVG. Now, MACD, RSI, of course, another concept that you can use. So the basic thing I encourage beginners to trade within key level to key level, which means trade between supply and demand zone. Secondly, mark your support and resistance to find an entry. And I will show you it's very simple, because the simplicity of this thing will make you to study more to understand how to manage it. Now, let's quickly look at this guy. So there are two instruments I mentioned, MACD or RSI, all right? MACD or RSI, but MACD can be used or RSI can be used. But for beginner, to make it easier for you to understand, I will encourage you to use MACD. All right. And I'll quickly explain to you the content of the MACD. And then the second indicator you may use. Don't depend on indicator. You see what I've just shown now, you can trade with it without using any indicator. Right. So if you ask me now, okay, Felix, how should I have traded here? Oh, you come here and you discover this has happened. We mark this point that when the market return back there. So imagine if I was to trade and I perhaps have marked this point, for instance, let's see here. So, and I go to my 5 minute. Sometimes I can go to 1 minute to find a sniper entry, right? And let's go to my 1 minute. So I'm going to find a sniper entry, but I will show you how do you now find your sniper entry. So look at it. For instance, okay. So look at it. Yeah. So, but ordinarily, I was already waiting that when the market come back, react, I'm going to sell, right? So, but even in the 1 minute too, we create a structure. So you can see now. But take note, a valid structure, a valid swing, low or high, must have three successful candle close in that direction. For instance, this is 1, 2, 3 candle red. That means this is swing low. Now, this guy was going up here. So this is a swing. Let me just mark it the same way you mark that 1 hour. So this is a high. Okay. And here is a low. Okay. And so what really happened is this. The market now went up this way. Of course, I was going to be selling from here. That was how you mark it. But let's say you didn't even sell. And the market move up, grab this. So all you wanted is, right, the market should come down. And of course, this is not complete. There's some strategy we talk about where they grab this and return back here. But so this is said to be part of this journey, and then this is where the low was collected. And after this low was collected, the market pulled back. Of course, it couldn't rally up again. That's probably going to form your sell. So your sell can be here or when the market return back to this point. And then, so while you are selling, so there's a scale. So I'm shorting, for instance, from here. Now there's a scale. Notice 1 minute time frame. Where should be my stop loss? Above this guy. Yes, you heard me right. Above that guy should be your stop loss. So that's about 1.13. So let's just take it that way. Now you are going to use 1:2 risk reward. 1:2 risk reward. So 1:2. One of the lovely things that as I arrive at my 1:2, it even aligns with the swing low that's here. You get it now. It aligns with the swing low that's here and align again with the key level. You remember we mark all this line. So it has come down to, so you have entered this. Now the part of this here, so there's a tip I put here. What's the tip? What's the tip? The tip is DCA, that's dollar cost average. When you buy in Forex, it's called stacking. You stack more. Then always use 1:2 risk reward, right? Then 5 fingers in the radar. Don't have more than 5 instruments in your radar that you want to understudy. If you have too much instrument in your radar that you want to understudy for your trade, that's going to confuse you the more. Most time people just create a lot of problem for themselves, trading too many instruments at a time. So 5 instruments in your radar, then 1 instrument per trading session. So for instance, let's say this is New York session and I want to trade and I've gotten to check maybe gold. If you are trading Forex, maybe gold, whichever instrument, work on that gold since you have identified it to trade. It's very, very important. You have identified gold to trade, work on it. Now, so we have done to the 1 minute. So you go back to your 5 minute, which is your normal trading area, our arena, as it were. Okay, so now you can see, so when you come back to 5 minutes, it shows more. So when you create more positions and you have taken the first take profit, so all of these things that the market is doing here, you don't need to be afraid. You have done the needful. All you do is that after I pull back again and correcting down, you are stacking more positions. That's the power of DCA. Okay. Now, so in that order, you are taking profit. Well, if you look at it, this guy is just getting choppy and choppy and all of that. So that's how you actually trade. I just wish I could find, oh, well, Bitcoin. Wow, 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 wow. I missed this. Okay, so there's something I need to add for you on that. So Litecoin is what we checked just now. Sorry. I was talking about, the instrument. So I said, so 2 instruments you will add, and if you want to learn how to master it, if you are not on our Plan B, Build with Me or private mentorship or our training platform, I think there's a need for you to enroll to learn more how to use all of those things. So now you are going to look for this flu trade. Those of you may not be able to identify your demand zone and all of that. So you just want it to draw it for you. Look at it. Flu trade SMC light. Add it and then you go to your indicator again and look for MACD. MACD. That's called MACD. But if you are going to see the write-up to give you the interpretation, it said moving average convergence divergence. Okay. So you're going to add it. So in my own case, I already have it here, flu trade. So I just enable it, right? And then MACD, I just enable it equally. Now, this is the lovely thing. So let's take out this guy. Now, the lovely thing about MACD, but you don't depend on it, please be very careful. Now, the lovely thing about MACD and this guy I've just shown you, what's it called? The flu trade. Now, MACD, you have done your basic market analysis, right? So if you look at the Litecoin now, it's pumping, right? So if you look at it, you have taken trade and enjoy your profit. And then the market now created the same kind of thing we're talking about. The market came down here. So when the market came down here, this was a low, right? You have marked this low ordinarily. So you have marked this low. This is what I do. Now, this is what I call support and resistance trading strategy. Now, you have, see how it's pumping. Come on, this is crazy, right? So you have marked this as support and resistance point. Now, remember I said every move creates an impulse, right? Every move creates an impulse. So when this creates a low, so what you're looking for is that the market rallied up. You want the market to return back here and either have a sharp rejection. Are you following? Sharp rejection to bounce or break it and fake out. So this is what they call liquidity, grabbing of liquidity. That because this was a kind of support zone and there are people who will place trade and put their stop losses here. So, and additional thing is this, look at it. This is on demand zone. The market actually came down there. So you are not going to see your flu trade will give you an idea that this is a demand zone and you want to pay attention to it. Number two, the market grabbed down and create inside bar here, then with a long wick of the candle. That's a sign that the market is coming up. Now, if you go to your MACD, look at your MACD, there's MACD cross. Now, let me quickly explain something to you about MACD. MACD is a fantastic indicator if the market is actually trending. If your market is not trending, don't rely on MACD. It's going to mislead you. MACD work with trend. Now, there are three components of the MACD. This one you are seeing here is called the histogram. And this blue line is the MACD line, while the orange or pink, whatever, is called the signal line. Now, the lovely thing about the MACD is that when it crosses, you want to check your price action. That's where you need to understand price action. So when MACD crosses, you need to understand your price action. Is the market actually moving? And do I have, market structure set as appropriate as possible? Now, but when this cross happen, you want to have the histogram too painting green. And the more like this one now, it painted green, and the next green, taller than this, that makes sense. That's very bullish, right? So, but even if you painted green, the next green was now fainting and even shorter, just like what happened here. It's going nowhere. So, but you can see this, it actually go. So you want to see that there's a cross, there is a histogram green punching out, and then, so that means, oh, that's good. Then you now look at your market. Come on, these guys. Who was I telling about this? The market today. I say be careful because markets will start pumping at any point in time. Ooh, I was actually doing a training for some persons. Let me see the trade I opened for them for training. And I actually said I was going to open a trade here too, but quite unfortunate I didn't remember. Okay, I opened a training style for the people here. So it's already 18% profit. It's already 18% profit. Good. So I was just doing experiment for the people. Okay, so now you have seen the MACD. Now look at your MACD have already crossed, and then you have your price action. Remember, you actually mark this guy. So as far as look at this pin bar, then you may not enter here, but after this engulfing is your entry, and then you are put your stop loss below here. But this is aggressive because this is not how market behave. Is because there are certain kind of fundamentals that are probably going on and all of that. So that's what you need to understand, because Bitcoin is pumping. Every other coin will have to join the narrative and get pumped too as well. So why? So you can now see, okay, see what even your what is called, even your flu trade already marked this place and call it break of structure. You know why? This was a high and there's a low. So this low was destroyed by this move. So now, ordinarily, in a normal trading condition, since this is broken, you are looking for a pullback, all right? A pullback perhaps back to this head or even here, and that's where you are buying. Don't get it twisted. Some persons, when they see this kind of candle moving, they jump at this candle. It's wrong. Because after this kind of massive candle, you want a correction or something like that. And then when you have jumping on top here, when the market is now coming down, you are fidgeting. Oh, they should hold it. Who will hold it? So you don't just jump at it and all of that. Though even this is 5 minute time frame, because if it's 1 hour now, you probably will not notice it significantly. And so that is the way, trading is done. So beginners can easily take a move. So, but I've just told now when the market is moving, you want to get to, okay, let's look at what Bitcoin was doing, for instance. So look at it now. So look at what happened here. Quite unfortunately, I was telling somebody I was going to long Bitcoin, but I didn't remember half time. So now look at it. The market was moving sideways, and eventually look at what happened. The MACD cross, and then painted, first correct back and continue to move. So at every support point, I mark it. Market come back there, enter. Sometimes market pull back and it didn't come down there. Oh, that make a lot of sense. I'll find another entry. That's how you use the support and resistance strategy to enter a trade and be very fine, right? Now, maybe gold now. Next thing, gold is just going to be pumping, perhaps, if you have a new narrative, as it were. So irrespective of the market, either crypto, Forex, synthetics, is the same pattern. Okay, I wanted to sell off this asset. And I saw, okay, this one didn't make it. So this one has given me profit. Now look at what I did here too. This is synthetic, well-trade platform. Now look at here. I entered long on this market and I'll show you. Look at it. And see the example I just gave to you. Let's go to 1 hour, show you something. All right, so now in 1 hour, probably when you can, now, of course, you have your key levels. So sometime in 1 hour, the market is actually not fantastic. You can probably see this market was ranging. So if I take my mark or even take this kind of this guy to mark this as a kind of resistance, right? As a kind of resistance. So here too, maybe I mark this, okay? Sometime just mark the bottom of this place and then drag it out to see within the region, probably I want to trade, okay? Depending on where you come in to see what's happening in the market. Okay, so let's go this way. So this is 1 hour. So where do you even say the market is going to now? So it can get you confused so much, right? So when I go to 5 minutes, I actually want to find a possible entry. And so what really happened? Felix, how did you find an entry at this place? Felix, tell us. Very simple. Felix find an entry. Market was doing what it was doing. No problem. You first mark this point because this is a low and expect the market to grab, which happened. So, but me, I was not here when this market was doing what it was doing. I came in here, and that was why I marked this. And sometime I said I mark it like a zone, the pin or the wick of that, and then stretch it out. And I wait. What am I waiting for? Okay, the market now went up and create a high, right? This one. So the next thing I'm just waiting for is very simple. I'm waiting for this guy to come down and either hit this point and bounce or come down and grab liquidity, which he did, and now move, or it will get to this point and never return to that point and move. Whichever way, I'm good to go. And what happened? He grabbed the liquidity. So Akula, if you are there, and that's why I always recommend people to trade single instrument per time. Since I was monitoring it, as far as this engulf back, ordinarily you're supposed to wait for it to cover here. But sometimes, because you already seen the activities, sometimes we find a sniper entry in. And what do? We can now do small position. Maybe after this candle, the next candle open and was still, so perhaps your entry was here. Now, where is my take profit? Is actually First take profit will be here, and second take profit will be here. Not necessarily getting to that this resistance. Now, my stop loss will be here below this point. Now, if you look at it now, this is 1:3 ordinarily. So if that's the case, the market, now when the market move and actually cross this guy, at the return again is another entry, I think, right? Oh, these are close. Oh, it's true. I said take profit on this guy. I forgot. Oh, shit. I forgot. I was like, when did he close? Where is this one? Oh, lovely. Thank you. I didn't know that it has closed the trade. Okay, now that means I must have, maybe I actually set my take profit on this region. Now, this is what happened here. This is what happened here. And of course, if I still take my MACD, you are going to see. Now, after this, I've taken, so if I enter like 2, 3 position, one take profit will be here. Sometimes those of you who are on our forum, you see that I will send such signal and you will see that I will mark it like this with a kind of orange line. And you see me. So anywhere you see this line, I'm telling you take profit. So at the bottom of this thing, you see the price 78,108 is your stop loss. This place is your entry point. Sometimes when you can, the price actually have left that point, but it's going up, but it's still in a very manageable point. You can enter, but you adjust your stop loss as it were. Now, what did I now do here? See what I did here? The market got up here. That's an impulse, right? And start moving back. I mark it. I say, okay, let me see what happened. If the market, though I'm not interested in trading it again. So, but if the markets have given me some aggressive kind of pattern, so the market actually cross it and grab liquidity, which is cool. And if you look at it here, I think this too was grabbed or just a sharp rejection. So now when it returned back to the region, right? When it return back to the region, I want to see a candle close. And not just a candle close, see this gravestone doji, right? This candle is my entry. I will have sold down. So I will be selling down this guy now. For instance, look at what's going to happen. Sell down this guy, right? And where will be my stop loss? Above this, right? So above this, where's my take profit? Of course, this is too close. So my first take profit is to be here, and then the second one down here. Now, so if you look at it, you can calculate your take profits. Have I been onto 1:2? Yes, here is my 1:2, and I'm okay. So stop loss here, all right? Stop loss above here, and I continue. You can be trading that and then be making money without struggle. Are you hearing me now? You can be doing that, making money without struggle. It's as simple as ABC. But sometimes we don't pay attention to simple thing. We complicate issues for ourselves, and then we just want to learn everything. Oh, simple support and resistance strategy can work for you, but you need to know basics of at least plotting your demand and supply zone and other, minor stuff that you need to do and all of that. Another thing you must know is this: once you have set up your trade, you have set stop loss, you have calculated how much you are going to lose if the market go against you. So don't bother. Just do other things. You probably just want to come to see how it's faring. And that's all. Not that you are struggling and then, oh, my market, what's going to happen to me now? Hey, if this market go against me. But you have told yourself, you have agreed that should in case the market lost this, agree to lose this amount of money. And that's exactly what you have told. And then you should have your peace. Okay? So you can see how MACD actually work. So if you go to that Litecoin now, you are going to see that it must have pulled back. Good. Look at it. So imagine you rush in on top of this place. Why? You shouldn't have rushed in top of this place because you missed the entry here, because that's the take profit of somebody. So a lot of people are taking profit there. So the market will be correcting back. So you wait for a pullback, and then at the return, then you want to find an entry. Because if you go to 15 minutes now, you can see. So sometimes when the market is not having volume, like what we're having now, market is not actually having much volume. So going to 5 minutes, even 1 minute, you can scalp and make a lot of money. Look at it on 1 minute. Look at your MACD cross, right? So, and then, so on 1 minute, you just need to know your owners anyway. So on 1 minute, you can see the up here, and then the market has been dragging, you have been marking it then finally look at this. This is your MACD equally cross aggressively, and look at the move. So your own move here, if you have entered the market here, what you will have done is very simple, because you probably were going to be taking profit here. So you find an entry here, and your stop loss was below this swing low, and then your take profit, if it's going to go, most time when I'm setting it, if I see a swing high there, but if you still go to 1:2, you are good anyway. But sometimes when you see a swing high at your left, you want to concentrate to take profit at that point, or at least your first take profit. And those are the things we encourage people to do. Okay, so beginners, 10 magic trading for beginners. So it's very, very important. So you learn, just follow the instruction, and then you'll be able to make money. What do I call it? 10 trading magic for beginner. 10 trading magic for beginner. 10 trading magic for beginner. So ladies and gentlemen, thank you for your time. And so even if it's stock, Forex, crypto, irrespective of that instrument, to do your data analysis, you are good to go. All right. So thank you for your time. And so pay attention and learn as much as possible. Come on.